1 crore rupees. That's the number everyone throws around, right? Just buy a 1 crore term plan, that's enough. But is it really though? Is 1 crore enough for a 30-year-old with 2 kids? Is it too much for a 50-year-old with no loans? Or too little for someone who just bought a flat in Mumbai? Let's find out. Welcome back to Term 101, where we simplify term insurance without the jargon. And in today's episode, we're tackling the one question that makes or breaks your policy. How much cover should you actually take? We'll give you a step-by-step way to calculate it based on your income, lifestyle, loans, and dependents. And by the end of this video, you'll not only know what cover you need, you'll know why that number makes sense for you. And hey, if you want us to run these numbers for you, we can do that. Just book a free call with Ditto. Our services are completely free. We'll calculate your ideal cover, suggest you a few good plans, and help you avoid under or over insuring yourself. The link is in the description. All right, now let's break this down. Here's the deal. If you take too little cover, your family might struggle to pay rent, EMIs, or even basic bills if something happens to you. But if you take too much cover, you're just paying extra premiums for protection you don't really need. So the sweet spot lies in a simple idea, and it's called income replacement. If your income suddenly disappears, how much money would your family need to maintain that exact lifestyle until they can stand on their own? That's what your term cover should be. Here's how we calculate it. Step 1. Replace your income till retirement. Now, let's say you're 30 years old today and plan to retire at 65. That's 35 years more of income your family depends on. So we look at your current annual income, say 10 lakh rupees, and we calculate how much they'd need to receive every year for the next 35 years if you weren't around. Now, this isn't a simple 10x rule because we also have to account for inflation, because 10 lakhs today is not the same as 10 lakhs 30 years from now. With a 5% inflation rate, your family might need over 2.3 lakh rupees per month just to maintain your current 40,000 rupees per month lifestyle by the time you would have turned 65. So we calculate the present value of the future expense using inflation and investment return assumptions. In most cases, this income replacement component alone comes to 1.5 to 2.5 crore rupees, depending on your lifestyle and remaining working years. Step 2. Adding your outstanding loans. If you have a home loan, personal loan, or education loan, that's an additional liability your family would have to bear. So we add that amount to your cover. Say your home loan is 30 lakh rupees. Your cover now needs to be an income replacement plus 30 lakh rupees. Step 3. Add any major future goals. Children's education, marriage, spouse's retirement corpus. Now, these are large lump sum goals that your absence shouldn't derail. If your kids are in school and you plan to spend 50 lakh rupees on their college education, add that too. Step 4. Subtract any existing life insurance. Say you already have a term plan or a LIC policy with a 50 lakh sum assured, subtract that from the total. Now, here's a small catch though. If your existing cover is only valid for another 5 to 10 years while your new plan will run till 65 to 70, don't subtract it completely. You can only offset what runs in parallel. Now, let's bring all of the 1, 2, 3, 4 steps together in this and take this example. You're 30 years old, you earn 10 lakh rupees a year, you have 40,000 monthly expense, a 20 lakh home loan. You want your cover to run till age 65 and you already have 50 lakhs of life cover. Now, here's what your calculation might look like. And remember, this is just an example. The numbers might actually vary. Income replacement till age 65 is 2.1 crore rupees. Home loan, as I said, 20 lakh rupees. Now, minus existing cover of 50 lakhs. You need an additional 1.8 crore rupees in term cover. Now, that is your number, 1.8 crore rupees. Simple, clear, and tailored. Now, are you still unsure how to calculate this for yourself? Just book a free call with Ditto and we'll do the math for you and recommend the best way to structure it. The link is in the description. Now, a few common mistakes people make while doing this. 1. Not accounting for inflation. 1 crore today may sound like a lot today, but it won't buy the same things 20 years from now. 2. Choosing an unnecessarily long tenure. If your financial responsibilities end by 65 or 70, please don't go till 99. You'll just pay more for no real benefit. 3. Relying entirely on employer-provided insurance. Those plans vanish the moment you change jobs and they're rarely enough. 4. Ignoring major life updates. Marriage, kids, new loans, these should trigger a review of your term cover. What worked at 25 might not be enough at 35. And finally, 5, delaying your decision. Because the longer you wait, the older you get, the more premiums you rise, the more premiums you pay. And worse, health issues can creep in and raise your costs or reduce your eligibility. So if you're watching this and thinking, just do it today. Okay, I should figure this out soon, maybe not today. Folks, it just takes 15 minutes to run the numbers with us and you'll walk away with a clear answer. This is how much cover I need. Here are the 3 plans that work. This is how much it'll cost. Done. Alright folks, in the next episode of Term 101, we'll talk about how long you should be covered for. Should you pick age 60, 70, 85 or go full throttle till 99? That's a hot debate and we'll settle it. See you there. Until then, happy insurance hunting.